The development of a trading strategy is a complex process, but the start of the process is always the entry idea. The entry idea might be as simple as going long after a candle close, or as complex as waiting for 1/3 retracement in the third wave of an Elliott wave cycle after a double MACD divergence. For many, the entry idea comes from the study of charts after they identify recurring up or down moves that seem to happen after a certain chart setup. If you find a good entry idea, the rest of the development process is pretty straightforward. Some traders use price action to find an entry, while others prefer adding an indicator for an extra layer of confirmation. In today's video, we'll discuss about market entries, and I will share my favorite indicators that help me to pull the trigger on a trade. Many will disagree with the statement that the entry is the most important element in developing a trading strategy. If they're trend followers, they say anyone can spot a trend and jump on board, but it's when you get out that makes the difference. Sure, when you get out is important, but the entry determines how soon and how quickly you find profit on a trade. If you find a good entry, you can get out randomly and make a profit on average, but you can't exit randomly and make a profit without a good entry, no matter how good your exit is. The entry is your edge, just like the house edge in a casino. Good entries have a power and persistence that are proportional to the number of bars used for the setup logic. Bars are information. One bar tells you little, but the more you have, the better idea you should have of what's next. If your entry uses 10 bars of information, it will have little forecasting power. If your entry uses 20 bars of information, your profit push should be higher and last longer than the 10-bar entry. Similarly, with 50 bars of information, you should get a bigger profit and longer persistence. You get the idea. So where you enter your trade can have a massive impact on whether you come out as a winner or a loser. Two of the most important forms of technical trading are using indicators and price action trading. When using indicators, traders are generally looking to execute a trade based on an indicator signal. Similarly, when trading naked price action, traders are looking for certain signals to execute a trade. For example, if the price forms a bullish engulfing candle, they will execute a buy trade, or if a trader identifies a bearish pin bar, they will execute a sell trade. While both strategies are effective, combining the two approaches can lead to better opportunities and stronger. Indicators, if used in conjunction with analysis of market structure and price action, can be very powerful tools as a support to your initial analysis. So let me share my favorite indicators I use to enter a trade. First indicator is stochastic. The stochastic indicator shows information about momentum and trend strength. The indicator analyzes price movements and tells us how fast and how strong the price moves. Stochastic indicator analyzes a price range over a specific time period, or price candles, taking the absolute high and the absolute low of that period and comparing it to the closing price. The stochastic oscillator is centered around the assumption that during upward trends, closing prices will move towards the higher end of the price range, and during a downtrend, prices tend to close at the lower end of the range. The indicator consists of two horizontal lines and two lines oscillating in between the indicator's range of 0 to 100. The oscillating line is labeled %K, while the moving average line is labeled %D. As an entry indicator, the stochastic can be used to determine overbought and oversold areas, to identify a crossover between the two lines of the oscillator, to determine the trend direction, and to identify divergence signals. Now, very important, all the signals must be used in conjunction with an analysis of the market structure and price action. Basically, the entry signal must occur at an important level of support or resistance. So before considering taking an entry with an indicator, you must mark all major support and resistance levels on your chart, as they could become relevant again if the price approaches those areas. The basic trading method for using support and resistance is to buy after a stochastic entry signal near support in uptrends, or at the parts of ranges or chart patterns where prices are moving up, and to sell a stochastic entry signal near resistance in downtrends, or at the parts of ranges and chart patterns where prices are moving down. Generally, when using the stochastic as a signal to enter, you look for crosses of the fast momentum line with a slower momentum line. In order to identify a buy signal, you should look for points when the %K line crosses above the %D line. Alternatively, The sell signal arrives when the %K line crosses below the %D line. Remember, around support and resistance levels. Overbought and oversold signals are noticed when the indicator takes values above 80 or below 20, which serve as thresholds. When the indicator value falls below 20, an oversold signal appears, while a value above 80 indicates an overbought signal. However, overbought and oversold concept is one of the biggest problems and faults in trading. Markets can stay in overbought and oversold conditions for weeks or months, so an entry relying on these conditions is a guaranteed way to lose capital in the long run. I would take the overbought and oversold signals only when the market reaches a key support or resistance level, and even then I would be careful with my position sizing. A better entry offered by the indicator is the divergence. You can spot a divergence when the price doesn't move in the same direction as the stochastic oscillator lines. Namely, when the price has higher highs while the oscillator has lower highs, it signals potential bearish divergence. If the price has lower lows but the stochastic oscillator has higher lows, then it's an indication of a bullish divergence. Again, remember that the correct reading of the oscillator means that you have primarily identified the overall market conditions and you have marked the correct support and resistance levels. Second indicator is ADX. The ADX provides information about momentum and trend strength. Since the market is in a strong trend only about 30% of the time and is in sideways about 70% of the time, this indicator is used to capture the period when the market shows significant trending or directional behavior. The ADX indicator comes with three lines, the general ADX line and the two directional lines. The entry signals are offered by the DI lines because the ADX line only measures trend strength. A rising ADX means that the trend is gaining strength. A falling ADX shows a trend that is losing momentum or reversing, and a flat ADX shows a sideways range. The values of the positive directional line and the negative directional line are based upon the assumption that when the trend is up, today's high price should be higher than yesterday's high price, and when the trend is down, today's low price should be lower than yesterday's low price. When the DI lines cross each other, they give a signal. When the positive directional line crosses above the negative directional line, it means that the highs and the lows of the previous candles are both moving higher, which confirms an uptrend. When the negative directional line crosses above the positive directional line, it shows that over the past candles, price has been moving down and the lows and highs are going lower. Basically, when the positive DI line is above the negative DI line, you should be long. And when the positive DI line is below the negative DI line, you should be short. Remember what we've discussed about the stochastic, the same principles apply here. All ADX signals must be used in conjunction with an analysis of the market structure and price action. ADX entry signals must occur at important levels of support or resistance. Third indicator is the Fisher transform. Fisher transform indicator highlights when the prices have moved to an extreme based on recent prices. This may help in spotting turning points in the price of an asset. It also helps show the trend and isolate the price waves within a trend. The oscillator moves above and below a zero line and has clear and sharp turning points. This simplifies the identification of trend reversals. The indicator consists of two lines. They are the Fisher transform line and the signal line. This is quite similar to the stochastic oscillator's fast and slow lines. When the value of the Fisher transform is above zero, it indicates an upward movement. When the value is below zero, it indicates a downward movement. So the Fisher transform has a signal line attached to it. This is a moving average of the Fisher transform value, so it moves slightly lower than the Fisher transform line. When the Fisher transform crosses the trigger line, it is used by some traders as an entry signal. For example, when the Fisher transform drops below the signal line after hitting an extreme high, this could be used as a signal to short the market. As with the previous indicators, Fisher transform will provide many trade signals, and many of these will not be profitable signals if you take entries in areas with no particular interest. I will say it once again, use the indicator in conjunction with trend analysis. For example, when the price is rising overall or the market is at a major support level, use the Fisher transform for buy entries. During a downtrend, or when the market is at the key resistance level, use it for short signals. Another entry signal offered by Fisher transform is related to divergences. Whenever there is a divergence between Fisher transform and price, it usually indicates that the prevailing price movement would reverse. A buy entry signal occurs when you spot a bullish divergence at a support level. It happens when the price forms a lower low and the corresponding Fisher transform value indicates a higher low. A sell signal occurs when you spot a bearish divergence at a resistance level, meaning when the price forms a higher high and the corresponding Fisher transform value is a lower high. As always, if you learned something new and found value, leave us a like to show support, subscribe to our channel and hit the bell icon to stay notified when we upload new videos. Until next time.